I'm Matt Bichard here in New York City for NAREIT's REIT Week, the 2018 Investor Conference. Joining me today is Dan DuPree, Chairman and CEO of Preferred Apartment Communities. Dan, thanks so much for joining us today.
Yeah, my pleasure.
Now, Preferred Apartment Communities acquired $1.1 billion in assets since the beginning of 2017. What sorts of properties are you really targeting at this time?
Our primary asset type is Class A multifamily. Basically, markets over 1 million people with good job growth. That leads to household formation, which contributes to opportunity. We then diversified into grocery-anchored retail. We thought there was an opportunity within the retail space if we narrowly define the product type. This is number one or number two grocer within a market. Sunbelt, basically Virginia down through Georgia, Tennessee, and then over to Texas. For example, in the Southeast, primary grocers for us are Kroger and Publix, and that strategy has worked really, really well for us, and it basically creates a bit of a hedge against variations in the multifamily market. Where longer-term leases, the IRRs work out about the same, but we get higher going-in yields on the grocery-anchored retail. More recently, we diversified into office. My son, Boone DuPree, had been senior person on the acquisition team at Cousins in office, and he joined us, and we're finding exceptional yields there. It's probably underappreciated a product type at this point, as multifamily is an overappreciated product type.
And what role does your real estate loan investment program play in your overall strategy?
I think we invest our money differently. We wanted to participate in the value creation of development, but as a startup company in 2011, we couldn't afford to invest our money without a return as we started up. So we came up with the idea of taking a select group of developers, people with whom we had long-standing relationships. Candidly, these were all developers who came out of Post. When Post moved away from the development business, when John Williams left, the developers splintered out and formed their own groups. And so we went to these people and we told them, we're going to tell you where we want you to develop. Again, the market's over 1 million people, good job growth. We're going to tell you what we want the product to look like. Gated communities, heavy on the amenities and the aesthetics. You're going to go out and you're going to get a construction loan. You're going to sign the guarantee. You're going to bring equity into the deal of 10 to 15% of the capital stack, and then we'll make you a mezzanine loan that fills the gap between the senior loan and the equity, typically 25 to 28% of the overall capital. We're going to get you to pay us a healthy interest rate, typically somewhere between 12 and 15%. But the kicker is we want an option to acquire the stabilized asset, or at market the stabilized asset, at a discount. And the discount early in the cycle was 50 bips. Later in the cycle, it dropped to probably 15 bips. So if market for an asset was a 6 cap, we'd buy it at a 6.5 early in the cycle. Today, we'd probably buy it with one. We wouldn't get it at a 6 cap. Probably be a 5 cap. We'd get it at a 5.15. The value of that purchase option discount typically $3 to $5 million. So really meaningful part of the program. The overall IRR on a typical mezz loan, counting the interest and the discounts, probably somewhere between 18 and 20%, which makes it very attractive to us and was a real mover for us, particularly early on.
And lastly, your New Market Properties grocery retail platform, which you touched on in the first answer, it's been very active of late. Where are you seeing the most growth potential there?
Well, again, we have a very well-defined market. I mean, it's Sunbelt. If you take a look at demographics and where the growth of the country has been over the last 20 years and where it is projected to be over the next 20 years, the Sunbelt, and when I say Sunbelt, I'm really taking the rim all the way around past Texas to Arizona and California. There was a stat that I heard I don't know, 5, 6 years ago, that something in the neighborhood of 60% of the growth of the United States was going to occur in 5 or 6 states: North Carolina, Georgia, Florida, Texas, Arizona, and California. And that's really where we're concentrated. The numbers basically help underwrite the deals that we do.
Dan, thank you so much for joining us.
My pleasure. Thank you for having me.
For more from NAREIT's REIT Week, be sure to visit NAREIT's website, REIT.com.